The broadcast is now starting. All attendees are in listen-only mode.
Well, good afternoon, everybody. Welcome to today's webinar. My name's Ric Spooner. Today's webinar is about just a collection of thoughts, I guess, that I've gathered over the years of putting together a basic approach and strategies towards combining the use of both technical and fundamental analysis. Now, of course, each of those subjects, the whole question of how to go about fundamental analysis, how to go about technical analysis, are in themselves very large questions. Today is not going to be about how to go about either of those forms of analysis, but more just about how to putting them together. And in particular, what I'm going to do is just to have a look at a couple of broad approaches to developing strategy that combines the two forms of analysis, and then to have a look at some examples of doing that on the platform. But to give it all some context to begin with, I thought I might just begin by making some observations about what I've found to be useful approaches to developing trading strategy, and to, particularly for stock trading, and to look at, as amongst that, at the overall approach to developing a portfolio for a trading as opposed to investing strategy or portfolio. Before I get going though, what I need to do is just to pause to give you a chance to read this important information, which says, amongst other things, that what I'm saying today is general in nature, that I don't know what your individual circumstances are, so I'm not in a position to judge whether what's being said today is appropriate for you or not, and of course it's up to you to make that judgment. Okay, well, just to begin then, on this question of developing a strategic approach to stock trading, although I think you see a lot less of it these days, this is the whole question of fundamental and technical analysis has been a bit of a culture war for traders and financial markets. And certainly there's been a tendency for proponents of each camp to completely dismiss the other form of analysis as rubbish and useless. Today, I think you do see a lot more of what we're talking about today, of people using both forms of analysis, and that it applies to institutional and professional investors, not just to we retail investors. And certainly the advent of algorithmic training and so forth has added to the use of this sort of mechanical, technical type of analysis, as well as fundamental analysis. But look, I certainly, I'd like $1, I think, for every presentation I've been to, particularly by technical analysts who begin by just slagging off at the other form of analysis. And I think in a way, financial education has got quite a bit to do with this. I think if you did a basic finance or economics degree at university, as I'm sure some of our listeners did, and I did, you were taught about the efficient market theory, and which in a nutshell says that all known information is built into the current price, and that what happens to prices in the future is only about new information. And that essential theory meant that the technical analysis is inherently wrong in their view, because technical analysis, of course, is about analysing markets and predicting the future based on past price. But look, I think you've only got to look at some price charts and be involved with markets for a while, it seems to me, and open your mind up to technical analysis to be aware that it does have value, and that markets do or are driven by more than just fresh information. They are very much driven by behaviour and the way humans respond to information, and that behaviour forms patterns in markets, and those patterns, I think, can, or I do believe can be used to make some sensible predictions about what's going to happen in the future. On the other hand, though, technical traders, to some extent, certainly in the past, probably less so now, have tended to be self-taught. So a lot of technical traders did not have or have not had sort of professional or educational experience in financial markets, and they've tended themselves to be a bit tribal about their own analysis and just to take the view that fundamental analysis doesn't work, is completely useless when it comes to timing markets and saying anything useful about them. And in my own view, both those points of view are incorrect. I must say that I came out of the first camp, but I was for quite a long time in my financial markets career dismissive of technical analysis, but at one stage I was fortunate enough to work on a dealing desk where we had a very good technical analyst that was pretty avant-garde for the days it was happening, and that quickly opened my eyes to the power of technical analysis as a trading tool. So the bottom line is I'm certainly an advocate of using both of them. That's been my own journey in trading in general and stock trading in particular. But of course, neither of them are perfect. Both of them are very imperfect tools, although they are useful. And so I think that's a starting point, that it's a matter of getting the best out of them, being sensible about their limitations, and trying to get and develop an overall approach to using them. And generally, I've come to the view, particularly with stock trading, over the period of years, that essentially I really like to know about 2 or 3 essential things when it comes to a stock. I want to know about its value, or my own interpretation of its value. I want to know about the trend in the market, and I want to know something about the momentum of that trend. And that involves me then using a combination of fundamental and technical analysis to develop a picture of what's going on, and then to develop, to build my strategy around that picture. Realistically, I think whether you use one or both of these forms of analysis, or which one you rely on most, is probably really a matter of your own interest. Are you interested in fundamental analysis of stocks and markets or not? Many people are not. If you're not, that certainly suggests leaning most heavily towards technical analysis, with perhaps using the advantage of somebody else's fundamental analysis as a bit of an aid to give you that valuation tool. And the other big thing for we retail traders and investors is, of course, time. Most of us are time poor when it comes to our trading. We need to be efficient about the way we analyse markets. And certainly I think technical analysis can really add a lot to traders there. It is a way where you can look at a lot more markets than you can possibly hope to do via fundamental analysis as a sole trader, and to more readily scan across a wider range of markets for opportunities. And as we've discussed, as I've said on the slide here, I mean, I'm sure most people are aware, fundamental analysis essentially refers to looking at a range of factors: economic, industry factors, the company strategy, company management, financial ratio analysis based on their past results and future expectations and so forth, to come up with a view about the company's earnings, its prospects for growth of those earnings, the risks associated with those earnings, and then attaching some sort of valuation to that earning stream. Technical analysis, on the other hand, is about using past price action to forecast what will go on in future. Now, a couple of other quick observations about overall approach to stock trading strategy. One thing that I'm a firm believer in, and certainly practice myself, is that I think you get a lot out of making a very clear separation of your investing and trading activities and running them entirely independently, which is what I do and what I've come to the basis of the best way to go about things. Now, of course, a lot of investors are not traders and don't have to worry about this, but most traders, I think, are also investors. But even investors, if they're not careful, indulge in a bit of sort of trading activity and get both their trading and investing mixed up a little bit. I define investing, I mean, there's a big crossover between the two, of course. They're both involved in the same market, in this case, stocks. But I define, loosely defining investing as the activity I do where I'm basically intending to own an asset for a long time. I'm involved in that asset, and indeed a portfolio of shares as part of my wider investment portfolio. And my overall intention when I buy something is to hold it for the long term. Of course, I'm trying to buy it well at a reasonable price, if not a cheap price, but having bought it, my broad intention is to stay with it to earn money over time out of that asset through as it earns income, and that income might flow back to me either in the form of dividends or price appreciation, and as its earnings capability grows for its capital valuation to grow in line with that improved earnings power. Trading, however, it is, as I see it, about buying something specifically because I think it's mispriced in the short term. It's either too expensive or too cheap. I'm going to buy it if it's too cheap, sell if it's too expensive. I aim to be turning over as much as I can. When I trade something, when I'm taking something from a trade, I'm hoping that it's over really quickly and I make my money and get out of it quickly. And the key difference between the two is that trading routinely involves losses. It's a matter of making losses and profits, and at the end of the day, for your profits to exceed your losses. And so that, particularly the fact that with trading you're taking a lot of losses, that calls for quite a different set of strategies. And I think you need to have quite separate strategies for the two, and even to totally separate your portfolios. You might have a stock as both a trading and an investment, but what I do is have a separate pool of money devoted to trading and investment and keep the two quite separate, keep totally separate records of the two, and so forth. Another thing I think it pays to be clear about when it comes to trading strategy, and by the way, today's webinar is mainly about trading, although I think technical analysis is also very useful for investors, and I will touch on that as well. But basically, I think I came to the view a long time ago in my journey as sort of developing myself as a trader that there are sort of broadly two approaches, I think, to trading strategy. One is to rely primarily on making having a larger number of profitable trades than losing trades, but to combine that with a good enough ratio of the size of my profits to the size of my losses. And generally, it seems to me that when you're basing yourself primarily on making a lot of profits, that involves taking relatively quick profits because you want to reduce your exposure to the market coming back on top of you and profit turning into a loss. And so, from a valuation point of view with stocks, that essentially involves the sort of thing I've got on the left-hand side of the screen here, which is, aiming to buy things when they're cheap and sell them, when they get back to your idea of fair value. Or if you're using CFDs and shorting the market as well, you're sort of aiming to sell things when they're expensive and buy them back to take a profit when they're at about fair values. So that's that higher turnover, smaller profit sort of routine. The other way of going about things is precisely the opposite. There you're looking at trading strategies based mainly on making big profits. That is, large dollar values of profits compared to the potential loss you're taking. And of course, this is the let it run type strategy where you're basically trend following. And this from a trader's point of view is the, getting involved in the really powerful strategy, A2 milk or whatever, and running it. And this kind of approach, I think, inevitably means that you're going to have a lot more losses. That's my experience with it. You're primarily involved in having, and kicking the ball out of the park a few times, so you're going to make some very big profits. You'll tend to have more losses, though. Typically, you'll have actually quite a lot more losses than you make profits. But as long as that ratio is good enough in relation to the value of profits you're making, you make money overall. And so either of those ways are, I don't really care which of those ways I go about. When I look at strategies, I look at both alternatives. But it is very important to be clear about which way you're going about things. Finally, the last observation I wanted to make about this is that when it comes to technical analysis, and one of the things that will inform the sort of comments I make for the rest of the webinar about how to fit things together, I basically look at technical analysis tools as just that, tools to give you a picture about what the market's up to, where it's trending, what the quality of that trend is, and so forth. And essentially, I think a very useful way to look at markets is that often, not always, but sometimes you will see these sort of big trends in play. Now, you'll see this whether you're looking at a 5-minute chart, and these big trends might be things that last a few hours or a day or two, or if you're out looking at a weekly chart, these might be things that are in play for months or even years. But it's a matter of the size of the movement in relation to the horizontal distance in the chart, the amount of time. But when you see these big impulsive trends, they're the ones you really want to get involved with, particularly with that second type of strategy we talked about, that trend following strategy. These are the big moves. So you're looking to identify those, and then there are a couple of good points on average, I think, to enter the market. One is when these potentially bigger trends correct, and when you can identify there is a correction and use your technical tools to say that it might be ending. That allows you to enter, around close to the end of the correction, so that if you're wrong, your stop can be close by, just below the previous low. But if you're right, on those occasions when you are right, you've got that chance of kicking the ball out of the park and getting involved in a large move in the direction of the trend. And large means large in relation to the size of the potential loss you take, which is what trading's all about. It's comparing profits to losses. The other valuable thing are these distribution and accumulation patterns, these broadly sideways movements that you often see at the top and bottom of trends. And so when you can identify those, entering the market near the resistance of a distribution pattern or a supportive accumulation pattern is again good risk reward country. It lets you get in close to your stop loss, but if you're right, join a potentially big trend, or alternatively get in on the break out of the accumulation pattern, where again you can have a fairly close stop for a bit of a retest back into the pattern. But if it's right and the accumulation is over and the trend is back on, then your risk to reward is fairly good. And if you're trading that first kind of higher success ratio strategy, where you want more profits, these are also useful points, the ends of corrections and the accumulation distribution pattern, because the initial move out of them tends to be high momentum. So you often get that better chance of a quick move up to your relatively small profit point, giving you a better reliability in relation to the size of your loss. Then finally, in terms of overall strategic approaches, I think another important consideration for stock traders is, if I'm going to be a trader, what stocks should I trade? Now, this is not a webinar about portfolio construction. Indeed, in this series, I do run a separate webinar on how to build a share portfolio, and I ran that a few weeks ago, and I'm sure we'll be doing more of those next year. So if you're interested in that topic, by all means, look out for that. But essentially, of course, from an investor's point of view, you're going to be looking at some combination of growth, yield, and taking into account risk. Where you fit in that is very much about your aims and your own financial profile, age, wealth, risk tolerance, and so forth. And you with an investment portfolio, you one of the key risk management techniques is to look at least reasonable diversification across the industries between defensive and cyclical stocks, large and small cap, and so forth. Now, with trading, I think it's very different. There are some things in common, but the first observation I would make about a trading portfolio is that they don't have to be stocks you like. I mean, as an investor, I'm looking, as we said, to own things potentially for the long term. I want to like the stocks. I want to like the prospect, the management, everything about them. If I'm going to be an investor in them, I don't really care about that much as a trader. Indeed, I particularly if I'm trading CFDs and on the short side, I actually actively like to have some stocks that I don't like in the portfolio because they're the ones that I might be more interested in selling. So when it comes to a trading portfolio, certainly, I continue to want to be concerned about the risk of the stocks I'm buying, because after all, I'm going to buy them hopefully for a fairly short period, but I am going to own them for a while. So I don't want to be involved in sort of excessively risky stocks where I've got too much chance of being caught in some sort of horror story or the next horror story that management foists upon its shareholders, or very risky industry situation and so forth. Similarly, I have some concern about liquidity. Your concern here will be dependent on how big a trader you are, but generally speaking, want to be involved in stocks where, if you're trading the small caps, where you want, can get out without too much cost if things go badly, either for the stock or the overall market. This is a key one for me with fundamental analysis. To the extent I'm doing my own fundamental analysis, I really like to concentrate on stocks I understand. Relatively simple stocks where I understand the industry and that might not be involved in too many diverse businesses and so forth. And or if I'm using third-party research, then I want the stock to be supported by decent analyst research, or certainly by the research that I'm paying for. If I'm involved in that shorter term sort of strategy that we looked at before, or this sort of one on the left-hand side of the screen, where I'm looking to buy when things are a bit cheap, get out at fair value, and make more profits than losses, then I want the stock to be fluctuating around my idea of fair value. In other words, my idea of the market's the value and the markets to be fairly well aligned. What's not appropriate for that kind of trading, in my view, are the kind of where I think something is very cheap or has got much better growth prospects than the market thinks. If I'm happily getting in on the early days of A2 milk, and I think the market's totally wrong about this and it's going to really get a lot more expensive, that's not the stock for that first kind of trading, because there I want to stick with it. It's more an investment stock, or more a stock for that longer term trading. And finally, it is very important for traders to concentrate on diversification as well. It's inappropriate for me to buy all the four banks because I think they're all cheap or all making interesting technical formations, as very all happens all at the same time, because with the four banks, it's more or less like one stock on the Australian market. So I do need it to be appropriately diversified, in my view, across markets, industry sectors, and companies with my trading portfolio as well as my stock portfolio. And lastly, what I wanted to get at with this slide is that where I'm looking at that second kind of trading strategy, the trend trading strategy, I personally use more or less the same criteria, the risk, the liquidity, supported by research, diversification, all those things come into play. The difference here, the key difference, is that rather than having a stock where my idea of value is fairly close to the markets and just fluctuating around it, there I'm looking for charts that fit my strategy, because here I'm looking for that big momentum trade. Excuse me 1 second. I'm sorry about that. And I want to be involved with the big trending chart. So, you know, I'm on the lookout for that kind of chart. All right, so those are my observations on overall strategy. Let's now get down to the heading of the webinar for the last half an hour and look at this idea of combining value and technical strategies. And I follow two basic approaches to this, or two different approaches to it, and I use both of them. So the first one is where my primary selection tool, my primary trading decision is based on valuation for a stock. You know, I'm mainly going to base my buying strategies about buying when I consider it to be cheap, taking my profit when I consider it to be back at fair value. And with that kind of strategy, what I'm doing is using technical analysis as a secondary tool to assist me with my timing. And so let's just sort of drill down into that and look at why might I do that? What might be some of the benefits potentially of technical analysis for me into that situation? Well, the first thing is, I think technical analysis, I believe, and certainly has been my experience, really helps with this falling knife syndrome that I've got here. That I'm sure a lot of people listening have had the same experience that I have, and that is that once a market falls into the level where I think it's cheap, it won't always stop there. It's by no means uncommon for a market to get into what I regard as the cheap zone and keep plummeting and keep on going and fall to even cheaper levels. And of course, that's a real risk for me if I'm only using fundamental analysis, because I get stopped out on all those trades. I buy them when they're cheap and then they move a bit and I've got to stop myself out of them. And I think technical analysis can really assist with this. Certainly not perfectly, by the way. I mean, you know, there'll be plenty of problems with it as well, and when it's wrong. But basically, I think it can act as a useful filter to improve results, to help with your timing, to sort of wait for times when the market starts to settle down, starts to find levels when it's already in your cheap zone, and that gives you a greater probability, I think, of finding some sort of a turning point. Now, as I say, everything's imperfect, so certainly you're just looking for this to improve your overall results. So there will definitely be times when technical analysis makes you wait on something that you should have got into. You know, got it into your cheap zone. It looks as though it's still falling as far as the charts are concerned. You don't buy it, and away it goes, turns around, and you would have made a nice profit out of it. So, you know, there'll be a lot of times when you have opportunity costs out of that, but as with all trading, what you're looking for it to do is to make this idea of combining technical and fundamental analysis to make more profit for you, or save more loss than it costs you over a year or whatever time frame you're measuring your trading over. A second really useful aspect of technical analysis for me, with this basic idea where I'm making my primary decision on valuation and buying when it's cheap, is that it helps, I think, give you a failure point. What a failure point is a level where you can take your loss and get out. And generally, I think if you're doing something like buying in a support zone, you know, you're buying in this support zone in expectation that the trend is turning and that from here on in we're going to see uptrend develop. And so that gives you a clear failure point. Below the low, the most lowest point in your support zone is where your idea has failed. You are buying in expectation of an uptrend, but if the market starts making lower lows or new lows, it's no longer in an uptrend. Your idea's failed. That's the place to get out. And so it does give you a logical set of reasons to put together the strategies about, well, okay, here's somewhere I can buy. And what's absolutely essential with trading is that once you've decided where you're going to buy, you should at the same time be deciding where you're going to take your loss, or your first loss anyway, and that lets you then compare the size of the potential loss to the potential profit. So that's the second key advantage, I think, is it gives you a clear failure point. So let's now get into sort of an example of an approach of this first overall approach to strategy, where my primary decision-making thing is valuation, but I'm using technical analysis as a secondary tool to help with my timing. Now, there are a couple of ways you can go about valuation. One is that you can do it all yourself. Certainly that's how I started. Well, I never did it entirely myself. I used broker and other research to sort of assist me with my ideas, but having done some securities analysis and accounting and so forth, I did have a go at it, creating my own earnings forecasts and valuations and so forth. Even if you're doing that, I think it's very useful to use professional research to assist you. But for a lot of people, I think it's a perfectly valid idea to use third parties to do your fundamental research. Certainly saves a great deal of time, and for traders, that that the saving time means that the whole idea of trading becomes more feasible, and it also has the great advantage that you can cast your net over more opportunities, which, if you've got a good strategy, will help to increase your opportunity over time, and also really helps with those other aims of having an appropriately diversified portfolio and so forth. So what I've done with this presentation is to use one of the tools on our platform that you can use as a third-party tool in this, which is the screener. And certainly I think it is, certainly an overall approach that does warrant consideration. I've certainly been having a look at it in the last few months when I've been looking at putting together these webinars, and it does seem to me to be something that really a basic idea that has some good legs in combination with technical trading. I'll go in and have a look at the screener in the platform now. Oh, no, I won't. I'll just go into this next slide before we go into the platform. But just to say, look, very basically, the screener's a star concept. It's a pretty common way of looking at markets, where it has a number of features, in this case 4, and it attaches, sometimes it gives a star to 1, 2, 3, 4, or none of these features. And the 4 features, and the one I think I'm focusing on most for this webinar, is valuation. So the screener applies a valuation tool to a company. It uses basically a price earnings to growth sort of model, which I think is a really good way personally of looking at markets. It does it backwards to the standard price earnings to growth multiple, for those who are familiar with how that works. But essentially what the screener does is takes a company's forecast growth and its estimated dividends, that's forecast by the market and estimated dividends, and divides that by its estimated price to earnings ratio. So it's essentially relating a company's growth prospects and income prospects to its valuation. And I think it's a really useful sort of way of looking at markets. It's useful because it's talking about forward projections rather than historical ones, so it means that you can more easily compare high growth and low growth companies. It's useful because it's an easy way of comparing different stocks and comparing the same stocks over time. And it's just basically, and it's most particularly from our point of view, it gives you, I think, a really useful sort of benchmark for our trading strategies, the valuation part of our trading strategy. Second thing the screener does relates to earnings revisions. Have analysts been upgrading or downgrading their idea of what companies' earnings are over the last 7 weeks or so? The fourth thing it does is look at relative performance. That is price performance of the market compared to the national index. You know, has it gone compared to the index over the last 4 weeks? And finally, it looks at trend and technical trend and whether it's increased, the price has increased or decreased relative to a basic technical level over recent weeks. So before I just go on then to sort of try and attach some strategy with that, let's go and have a look at this on the platform now. So you can access the screener in various places. One is if you go into the tools function here on the taskbar at the top of the standard platform, and just select the screener. Then you'll be presented with this header page. Now, firstly, that here you've got some basic information on how it works, but also a good thing to do if you are considering using this is just to Google them and look up their website, where you'll get some more information as well on how the screener operates and the sorts of things I've just looked at. Now, the second thing on this page here is a list of stocks that have been recently upgraded by the screener, followed by a list of stocks that have been recently downgraded. That means they've got an extra star or lost or dropped a star has dropped off. The other place to go in, I won't do this right now, but you can easily do this. If you go into the individual stock, whatever it is you're looking at, and go into the home page for that stock, well, let's do it. You know, we'll say NAB, then you'll see the screener analysis for that stock there on the home page of the analysis section of each stock. Righto, well, so that's the sort of background. Let's have a look at now how all that might be fitted into our strategy. So the first thing I want to do is, before I get into valuation or technical analysis or anything like that, to go back to the beginning part of this webinar, is that if I'm considering buying a stock, it needs to fit with my portfolio rules. Remember, I had a set of benchmarks that I was going to use to create a trading portfolio. They had to fit my risk profile. They had to have appropriate liquidity. I had to have appropriate diversification and so forth. So it's got to fit into all that to begin with before and what I do is, you know, create a list of stocks that fit into that portfolio, and depending on the nature of the strategy, it might be quite a large one, but that sort of then just saves me a bit of time and gives me an idea of what I should and shouldn't look at. Now, when it comes to risk, you might have noticed that the screener had a little risk tab for each stock, and basically it's got a neutral sort of low risk out here in green, and this red zone is telling you it's a high risk. So for the purposes of this strategy, a second approach for me is to say, okay, firstly, the stock's got to fit my portfolio rules. Secondly, I'm only going to buy it if the screener risk ranking is neutral or better. neutral or in the green zone. I'm just not going to be interested in any stock that's in the red zone. That's going to be too high risk. My third criteria is going to be the screener valuation rating. Now, I'm not interested in all the stars for the screener. The reason for that is that I'm doing my own technical analysis. So I'm not interested in their 4-week relative valuation star and their technical trend valuation star. And I'm going to assume that the earnings revisions that have been made are already sort of in the price. So, but particularly with those ones of earnings revision and technical, 4-week relative performance and technical trend, I'm doing my own technical analysis, and I'm likely to be most interested in things that have, because I'm looking for things that are cheap, things that have actually performed relatively poorly recently are the ones that are potentially going to be interesting to me because they'll have got into cheap zones. And similarly, things that have had a relatively poor technical trend recently and have been falling and doing worse than other stocks might be the ones that are of most interest to me in this valuation type strategy. And then the last thing is that if a stock complies with all those things and the screen is telling me it's cheap, it's got reasonable risk, and it's a stock that fits my portfolio valuation rules, then I'm interested in buying stocks that are confirmed with a technical analysis setup. One that might be, to go back to my former analysis, where a correction might be ending, a downward correction might be ending, give me a better risk reward chance to buy, one that might be testing the support of an accumulation pattern, one that might have recently broken out of an accumulation pattern, are the sorts of things that might interest me. Now, what I also should have said, is with the screener's valuation ratings, here, again, if we go into the screener page, you'll see that they have a series of valuation ratings. So their 2 green arrows means the ones that they think are cheapest. 1 green arrow is quite cheap. A circle is neutral. 1 red value is where they think it's a bit expensive, and 2 red arrows is where they think it's really quite expensive. So using the valuation part of their thing, that's why that strategy that we're looking at just hones in on those stocks with the 2 green arrows and doesn't worry about the other stars. All right, so let me now let's go and have a look at just a few examples of stocks that I plucked out. And basically what I did was just took a little bit of a tour through this yesterday afternoon and came up with some of the stocks in this list with the 2 green arrows that complied with the other benchmarks we've got on fitting the trading portfolio and having a reasonable risk profile, and at the same time I've got quite an interesting chart outlook. So one I noticed was Bapcor. Now, let me go in and have a look at this stock here. Bapcor, for those not familiar, is an auto trading company, sells accessories, spare parts, and so forth. And it has a whole lot of brands, including Autobahn as one of the more recognisable ones. And as you can see, it's got the double 2 screener rating. It's in the neutral risk zone. It's in the ASX 300 at least, I think, and has reasonable liquidity. So now, if I was to go, I now will go into the chart. Now, the place to go and look at the chart is in the advanced chart tool here on the platform. Now, I set my charts up with presets for the daily and weekly and monthly charts. So I can just easily switch between tools, and I save the work on, or a lot of the work I've done in charts, which I can do here with each preset. When I put drawings and technical tools on the chart that I want to use, I just update the settings, click that, and it'll save it for me, so I can just come back to it and look at it. So now, my own sort of technical idea of this chart is that we've been in this big accumulation pattern here, this very large triangle formation. It broke out of it. So remember, we're looking for those breaks out of accumulation patterns. And remember also, this is a 2-star valuation pattern that even though it's risen quite a bit, the screener still regards as being cheap, relating relative to its earnings profile. And what interests me from a chart point of view now is that it's done the classic thing, having broken out of that this accumulation pattern. It's come back to just retest the old resistance, which is now the new support. So my setup here is just this typical strategy for me, is that if it confirms this by closing up above this high, and really confirms the retest now by starting to move away for it and closing up above there, then that would be my buy signal, and the failure point would be down here. So it's made that if it does that, it's confirmed the retest, this has become the support. I want the uptrend to continue here. If it moves down below this low, the chart's telling me I'm wrong. And so there's the example. That's the sort of overall way of looking at this. 2 stars, reasonable risk, fits my trading portfolio, and now has possibly, if things move that way, a trading setup, chart-based trading setup. If there's no setup, and it doesn't close above this, well, it's just back to the drawing board, and potentially then personally I would be looking for some move back into this pattern and a lower support and basing pattern as a buy. Now, another useful thing on the charts with in the platform is that you can set up a watch list for yourself to easily just flick through the advanced charts you're watching. So I've set up one here for this combining webinar. And then if I could just click on the code, having set the watch list up, and I won't show you how to do that, but I could just click on the chart, and that will automatically bring that stock into my advanced chart. So this is fantastic. I think for me, gone are the days where I need to have sort of multiple screens watching a whole lot of charts. I can just easily flick through the charts I'm interested in and have the charts expanded out, taking up the whole screen or whatever I want to do, which just makes things more useful. So now capture charge, I won't go and show it, but if you have a look, it's also 2 valuation arrows, neutral risk growth. Now, a lot of these stocks, of course, in this valuation technique, this is the typical valuer strategy here, where you're looking at buying things that are beaten up, buying things that have really been smashed, that the market hates, that are out of vogue, is what you're doing when you're buying cheap stocks. And cab charges certainly fits into that. It's been a horror story for investors, and of course that's all been about disruption and Uber, but it's fallen to low values. Uber itself potentially having regulatory problems as well. And what interests me now, and we don't have time to go into patterns, but this is the 3 drives pattern, potentially a basing pattern that Larry Pesavento, when he did his masterclass out here, went through, and which you can read about in his book, Larry Pesavento, Trade What You See. And so you get these 3 sort of basing patterns, often forming a bit of a trend line like this, but also often quite symmetrical. So down here at this 157 level, this second swing down would be the same size as the first swing down, and potentially close to this trend line. So that's my setup. I mean, if it falls into here, forms a base, starts having made lower lows and lower highs, starts making higher lows and highs, then that would give me a failure point somewhere in here to buy with my stop under the low, and then looking for this stock to go on with it, then break out of the 3 drives and restore some of its value. So again, typical approach, valuation arrows plus technical setup. Very quick flick through a couple of extras. Monash IVF, as the name implies, is an in vitro fertilization company. Competitors are Virtus and also Primary Healthcare, which is now offering IVF services. Now, this company copped a drubbing recently when it announced that in the near term it was looking like its market share had dropped a bit. It's aiming at the premium part of the market. Primary Healthcare is looking at the cheaper part of the market. It's had a few management problems, but it's just announced a new CEO. It's in a market which many analysts think the overall market has got good growth prospects. For example, it's leveraged into a growing sort of middle class here in Australia and elsewhere, to the growing demographic trend for women to live at later, to have babies, and for the overall growth in the population. And so that means that it's got 2 screener arrows, because whilst it's short, in the short term it's been hammered, analysts, rightly or wrongly, still consider it to have decent growth, long-term growth prospects. And it was one of the stocks on that list that is close to, or possibly in a situation where it might meet one of my strategies for the end of corrections. I look often, as readers of the blog and the chart forum will be aware of, this AB equals CD platform where of strategy, where corrections often end at a point where there's a harmonic relationship between the second swing in the strategy and the first. In this case, at around about this $1.20 odd level, the second swing would be the same as sized as the first leg down in the swing. And we're just showing possible signs of forming a bit of a base around here. We may or may not, but if we do, then things currently stand for me a move above this resistance, this recent high, and particularly a close above it. We're starting to signal higher highs and higher lows from a low that was close to this AB equals CD point. Gives me my technical setup for a 2 arrow stock, and again, close failure point. Hoping for a nice recovery at the end of what has been a very large correction. If not, we just keep falling, the technical setup fails, and I'm on the lookout for another technical setup that might give me a buy reason. I'm just eyeballing it, that might be perhaps around associated with this major low down at $1.05 and the potential support of that. A couple of others very quickly. Regis Healthcare. Interests me. Potential accumulation pattern going on here, I think. Sideways triangle sort of a pattern. 2 arrows and all that applies. If it was to fall to the support and bounce off it, reject this support again, if it did that, then that would be a buy set off the bottom of this accumulation pattern, then looking for a turn to the resistance and potentially a break through it. And then lastly, my final example was Qantas. Now this just demonstrates, I think, for me, the fact that the stock trader, particularly people looking at valuations and so forth, it's all pretty medium-term stuff. Patience is a virtue. A routine part of the game is just identifying things that might be quite a long way away at this stage that might, at some stage, perhaps in the next days, weeks, or months, end up being a setup. So Qantas, interestingly, because of its growth prospects, is a 2 green arrow stock for the screener. It looks to me as though we might be correcting this whole correction here. This looks like a 1, 2, 3, 4, 5 Elliott wave sort of a situation. And down here, we've got the 38.2% retracement, the 40-week or 200-day moving average in this previous low, all in this sort of, roughly $5 to $5.20-ish kind of an area that looks to me as a possible support zone. So if we were to fall into that and again show a sign of turning there, that would again give me a possible turning point for a buy with a clear failure point. So hopefully that's a sort of enough examples to get an idea of the sort of combination, the overall approach to combination. But as I say, a whole range of technical strategies I've canvassed there, because technical analysis is itself a whole new subject, of course, with a lot of ways of going about it, and a lot more than we can cover in a single webinar like this. Lastly, I just wanted to finish off by a quick look then at the opposite approach to what we've been talking about, which is my second overall approach to this job of combining technical strategy with fundamental analysis. And here my approach is to do exactly the opposite. Here, this is for the technical trader here, where we're looking at our primary tool being technical analysis. Our basic strategy for finding setups will be chart-based. And I must say, what I have found to be a really useful filter for technical strategy is to use fundamental strategy as a filter. This is very similar to the basic concept that seems to be the majority of good technical analysis strategies have, where you're looking to trade in the direction of the longer term trend on the longer term chart. Here, my basic concept is that I'm probably still looking to do that. I'm looking for technical analysis setups, but I'm only interested in buying stocks that are cheap or neutrally valued. I will reject technical-based buy setups for stocks that are expensive. And I find that's a really useful way of improving the results in technical analysis strategies. It doesn't work all the time, naturally, like all strategy. It's certainly going to keep you out of a lot of technical analysis strategies that you might otherwise have done that'll go on to be good profits. It's just that if it is going to work, it'll keep you out of more losses than profits that you would otherwise have got in, and so result in an overall improvement in your technical trading at the end of the day. So here, the strategy is just basically the sort of flip side of what we're looking. It's got to fit the portfolio rules in terms of liquidity and so forth. It needs to be at least neutral as far as the screener's risk strategy is concerned. If it complies with all that, just like the other strategies, then I'm looking for, as my second thing though, as for it to be a technical strategy, end of a correction, off the support of an accumulation pattern, breaking out of an accumulation pattern. And if it does all that though, I'm going to reject and not bother about any buy trades that have got red arrows on the screener, either one or two. I will accept neutral ones where it's a circle, and of course, if they happen to be green arrows, so much the better. Now, we're running out of time, so let me just look at one example of this, but I think it's pretty clear how it would all work. But let's just go in and look at National Australia Bank now. NAB, banks under a bit of pressure this morning with the announcement that we will have a Royal Commission into the finance industry. So it's a stock of interest. We saw here this accumulation pattern historically that resulted in a good, gave a good result for this stock here, buying off the base of this, or the breakout of it, or the retest of it, and we got going to the upside. Now we've come back to retest at this previous low. So straight off the bat here, this would be possibly a chart of interest if we were to reject these support levels again. And again, because now we've got this clear failure point. So if we started making higher highs and lows off here, that would be encouraging. Now, as it happens, this is a stock that does have 2 green arrows with the screener, as well as a neutral risk rating. But even if, as I say, it was neutral valuation or 1 green arrow, then it may potentially be of interest for me, given its chart outlook. But in terms of being patient, the other thing that potentially interests me about this stock might be this, that if we're retracing this whole move here, sorry, I'm looking at, give myself enough history there, let me get rid of that. Let's go to the weekly view of this, just give it a bit of ourselves a bit of a longer view of life here. Let's say we were retracing this. This looks like 1, 2, 3, 4, 5. We might be retracing that whole thing. So we stopped before at 50%. We've come back to 50%. Down here we've got 61.8, and you can see where I'm coming here. The A, B, C, D. And I had a look here at what might be the harmonic possibilities here. So I get the Fibonacci expansion tool, click firstly at the top of that trend, second at the bottom of that trend. So those first 2 clicks pick up that distance. And now click thirdly at the top of this trend because I want to project that AB move from here. And there it is, the typical harmonic Gartley trade where this is the same level as that at the 61.8 down at the 27.85 level. So they're just on my watch list. Either a rejection of this support now in the next few days or week or so, or if we keep tumbling through here, then if we happen to fall to this level and then moved away from it, that could also be a possible technical setup. And then I apply my valuation filter, which in this case is the screener arrows, and it complies with that, and then so that goes onto my watch list. Sorry. We're a little bit over time, but there are other valuation tools in the platform, of course. The Morningstar one is another one. It's widely used. I won't go into how that works now. You'll often see differences between Morningstar and the screener. That doesn't mean to say one's better than the other. It's just typical of what happens with fundamental analysis, as it is with technical analysis, that people have different opinions about valuations, about growth forecast and earnings forecast and so forth, and it throws up different things. The screener one just appeals to me because it does have that price earnings to growth as its basic valuation tool, which is generally the way I like to look at markets anyway, which is why I used it as the basis for this webinar. And lastly, just a reminder that there is a fair bit of analysis available on our various platforms. On the stock platform, have a look. You can see our insights, as well as the screen and Morningstar, lots of information about stocks in general. On the CFD platform, those who use it will be aware of other features, access to our YouTubes, access to the chart forum. And of course, or there is our website where we run a blog as well, which includes articles on all sorts of things market related, including on individual stocks and both technical and fundamental analysis of those stocks. So look, thank you very much for joining me today. I'm sorry I've gone a little bit over time, but I am prepared just to wait around. If anybody has any questions I'd like to answer, then I'm happy to provide an answer, as long as it's something that I can do so. Okay, well, thanks very much, ladies and gentlemen. It appears you're going to let me off scot-free today, but thanks for your attendance, and look out for other webinars. We usually run at least one webinar a week. Not only Mike McCarthy and myself, but also Trade with Precision, our education partners, will discuss a whole lot of a range of topics relating to trading in these webinars.